because we have such a long history of commercial real estate data. We've seen how the market performs through multiple cycles in the past. And so we've gotten pretty good at developing reliable forecasts. But now there's so much in the air that we didn't have to think about before. Primarily the public health situation, right? That's never a factor that has gone into a commercial real estate forecast before. But here's what we're looking at based on our best assumptions. You've seen, and we talked about the earlier part of this graph where we've already seen this sharp demand drop off. Now, the economic assumption that economic forecast that kind of underlies this commercial real estate forecast predicts that the worst of the job losses are behind us, and we have seen some evidence of that. That companies began to add jobs again in the second quarter, and the job growth began to creep back a little bit. But you could see that the overall forecast here is that demand will remain pretty stagnant, that we're not going to have these major losses that we saw in the earlier parts of the pandemic, that the apartment demand will remain pretty stagnant really through the first half of 2021. At the same time, you're going to have a lot of new apartments still delivering. There's a lot still underway. There's no evidence really that developers are looking to delay opening. They've still got to pay taxes, still got to pay their mortgage. So they're opening their doors and trying to get tenants in there. So when you have a lot of new stuff delivering in an atmosphere of stagnant demand, that will continue to push vacancies higher. Our forecast is at the kind of the worst part, or at the epicenter of this for vacancies to get up to about 7%. So obviously that's very high from a historical perspective, much higher than we've ever tracked, and a complete departure from this generally 4% vacancies we've enjoyed for most of the last decade. But again, before the outbreak, the national vacancy rate was about 6.5%. Really speaks to the strength of the LA market, that in the worst financial and public health crisis of our lifetimes, our forecast is really just for vacancies to get it back up to about where the national level was prior to the outbreak. So, I don't want to belabor the point about strong demand and limited supply here, but all those factors really combine to underpin the strength of the LA market and should aid a recovery whenever the public health situation doesn't. And with a quick look at pricing here, this gives us kind of a relative view of the three submarkets that we focused on today. Again, Pasadena in green, LA County, this dotted black line, San Gabriel Valley in blue, and Southeast Los Angeles in orange. So we could see pricing in Pasadena had gotten up well above the LA County average, up around $375 a unit. But in that more Class B, Class C area, the type of product that's more prevalent in the San Gabriel Valley and Southeast LA, prices really still up dramatically, just even in the past 5 years, pushing $250,000 a unit in Southeast LA and $300,000 a unit in the San Gabriel Valley. So these are price points that, Chris, I'm sure when you started doing these presentations 10 years ago, would have been pretty unimaginable in these areas, $300,000, average of $300,000 a unit. But the overall strength of the LA market, those years and years of strong rent growth that we saw, it pushed up prices everywhere. You had a lot of investors during the last expansion that were priced out of West Side markets or Central LA, but really found a lot of value in San Gabriel Valley and Southeast LA, doing value add investments or just more reasonably priced investments in those areas. So you can see the overall forecast for pricing, and this should be kind of taken with a grain of salt because we saw how little trading is going on right now. So there are very few deals to base a forecast off of. But if our overall rent growth projections hold true and rents continue to decline through the end of this year, that will obviously limit returns and detract from returns in these buildings and translate into an overall drop in pricing. And you can see while the levels vary from submarket, that the general trend lines are about the same. We're looking at a forecast for about a 10 to 15% drop in per unit prices, average prices, before the market regains its footing and really gets back to normal relatively quickly. This is sort of predicated on an assumption that the economy gets back on its feet in mid-2021 and continues to accelerate through mid-2022. But if that proves to be true, then from a pricing standpoint, we should have made up most of these losses that we're forecasting within a year or two. And I think that kind of speaks to the underlying dynamics in LA that we talked about today, that the strong demand, the relatively limited competition from new supply, all of those make this a very compelling market for long-term investment. It's a tough place to make a quick buck because prices are so high, but with our diversified economy, our huge population, we're insulated more from some of these shocks that a smaller or less diversified metro might have during a downturn. And I think we'll see evidence of that in the coming year or so, that LA will probably weather the storm better than more heavily built areas or less diversified areas.
I'd like to share some data with you. Essentially, we looked at the last recession, and we looked at values from 2006, the peak, to about 2011, which in our submarkets was about the bottom of the market. What you're looking at here essentially is we took the highest price point that we could find, or I mean, we eliminated some outliers, new construction and so forth. But again, keeping in mind the general supply that turns year after year in these sub markets. And this is the percentage in values that we saw, again, from 2006 to 2011. You had the 605 corridor went down as much as 21%. The East San Gabriel Valley, which can be a discussion for another time, but who was really the beneficiary of a lot of foreign money that came into the States at that time. So it was propped up very well from those investors. East Los Angeles, again, it's one of those areas. It's great when it's great, but it's horrible when it's horrible. And so it dropped off significantly in terms of price per unit. Pasadena, again, they had dropped significantly in that area. Western San Gabriel Valley by 14%, and then the 710-91 corridor by 33%. And then the Inland Empire between 20 to 30%, depending on what section of the Inland Empire you're looking at. And the reason why I bring this up is because we showed this. I mentioned, again, our educational event that we had in March. And we wanted, because, people were very nervous at that point. Again, we're in front of a crowd March 19th. And we were sharing with people, well, if the past is any indication of the future, it shouldn't be any worse than this. And so what you shared with us is that we're not going to see declines anywhere near what we saw during the last recession. And again, at worst, for most of these submarkets, it might be 15%. But keeping in mind that we turned off the world economy for nearly 3 months, if we had a 10 to 15% slip, that would not be the worst of things. And again, CoStar is predicting that we would bounce back very quickly, similar to what we've seen the stock market do. I mean, we're talking about almost new highs today at the recording of this video on the stock market. So just as strange as this pandemic was in the return, the economies, the return of commercial property values should bounce back faster than you would normally assume from if in fact this is a recession.
Yeah, I think so. I would just highlight that the pricing information we looked at earlier was medium pricing, whereas this peak to trough is naturally going to be a little bit more volatile. So we think median pricing is going to fall by about 10 to 15%, and that would not that's obviously not the same as a 40% peak to trough drop in a place like Pasadena. So just so we're clear, we're maybe not comparing apples to oranges there, but I think your larger point is correct. There are some indications that in terms of vacancies or overall rent losses, that this recession is going to impact the local market more than the last one did. But the other kind of outlying economic factors, particularly that this has fallen more heavily on individuals and lower class than it is corporations and things like that, probably mean that the overall amount of investment and overall pricing is not going to pull back in LA long term like we saw to the extent of the housing crisis. We'll see. Obviously time will tell, and if things stay volatile for years and years or an extended period of time, that could change. But kind of as I said, the underlying dynamics for LA, it's hard to do, but when you strip out what's going on with the pandemic, that sort of structural foundation of the market that was so attractive prior to the outbreak is still there and is really not going away.
So the good news is multifamily still proves to be, even when you look against the other sectors, how retail is doing right now, office space. I mean, they're taking a beating, just which is a reflection of the changes that this pandemic has brought. But multifamily is strong, will continue to be strong. And I think that's reflected in, I mentioned earlier, part of this poll, the second question was, what is the sentiment amongst investors? And the far majority tend to be more optimistic than they are, or they outnumber those that are pessimistic. And so there's reason for such, right? I mean, again, if you correlated the values directly to vacancy and asking rents, and so as this turns around and as rents get stronger again, so will the values right alongside of it. And I think that's important for our viewers, so that again, many people would argue, well, because of the eviction moratorium, because of rent control, because of these various things, values should fall more. But again, that's not an argument. If the fact is, if they're not, then they're not, right? When we can argue that maybe that we should see, just like people could argue that the stock market shouldn't have bounced back as quickly as it has. But the fact is, it's back, right? And we're talking about almost new highs. And so there is plenty of reason as a landlord to be optimistic going forward. Any other closing thoughts that you would share with our viewers? Again, if I'm a mom and pop investor, I'm thinking about the my long-term investment goals. I'm even thinking about the building of my financial legacy, my heirs that will come behind me. You've been with CoStar 15 years, just a general sentiment of how you've seen multifamily perform, good or bad market?
Yeah, I mean, there's a reason that multifamily has been kind of the preferred investment vehicle, both in Los Angeles and the nation as a whole over the past few years, because of the resiliency of that space. People can stop going into the office, right? They can stop going to the store, but they're still going to need a place to live, right? Regardless of the overriding economic conditions. And in a place like Los Angeles, where for decades we have not been building enough to keep up with the demand for housing here, a year or two of disruption, while it will certainly cause some short-term pain, and I don't want to downplay the implications for individual owners and individual projects, but from more of a macro perspective and a long-term perspective, there's still plenty to like about Los Angeles, and more than anything else, that disparity, that long-term disparity between supply and demand, the inability to build enough new housing to keep up with the demand for housing in this area, really sort of insulates those owners that are lucky enough to own in LA. It insulates you from the highs and lows of other investments. And really, when you look for the long term, it's hard to see anything really dramatically changing the dynamic that has made LA multifamily such a compelling investment in the past. It will remain so in the future, regardless of these short-term spikes and shocks to the economy.
Well, Steve, thank you. I appreciate your time. I know our viewers appreciate your input here. They're just looking for a beacon of light, right? There's a lot of darkness right now. And so that's why we wanted to give them an update exactly where is the market as of today. So thank you, sir. Thank you for being so generous. Thank you to you and CoStar.
Happy to be here. I hope it was educational for your listeners, and thanks for inviting me to join.
I hope you found today's interview informative. My goal, the reason behind these videos, is to ensure you as the landlord have the information, the resources to help you in the day-to-day management of your multifamily properties and in the building of your financial legacy in multifamily real estate. Be sure to share a comment with us. What did you like? How can we improve? Who else do I need to go out into the market and interview that would assist you as a landlord? Please give our video a like and be sure to share it with other landlords that you know. Keep in mind, CoStar's data is not readily available to the open market. It's a subscription-based service that typically only brokerage houses have access to because it's very expensive to pay for this service. But CoStar was nice enough again today to be open to this interview to open up their analytics to share with you, our viewers. Be sure to share the video. And keep in mind, coming up here over the next couple of months, we are going to host our educational, what used to be a luncheon will now become an educational webinar, given the current issues in society. We can't have large gatherings. And over the last 10 years, several thousand landlords just like you have come through our events, and we've had a whole host of individuals on our speaker panel that speak to the legality of owning multifamily, protecting your assets, growing your wealth, protecting your rental income from Uncle Sam, and everything in between. So it's a what you saw here today. Think about over the course of a few hours, the legal aspect of owning multifamily real estate, the economic portion of owning multifamily real estate in terms of taxation, asset protection, market forecasting, and really, again, how do you build your financial legacy on a strong foundation that can't be rattled when things like a pandemic or when we go through some other change in the market, but with the sound advice, you have a strong foundation for your legacy. Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.